All right. Hey guys, welcome to the Atlanta Landlord Luncheon. We are excited to have you here again this June. So our goal at the Atlanta Landlord Luncheon is to bring you monthly education topics, market updates, and networking events to help buy and hold real estate investors build long-term wealth through real estate. So you're welcome to follow us on Facebook, LinkedIn, at the Atlanta Landlord Luncheon. You can also find us on YouTube. And just to offer up a networking opportunity that's coming up next week. On next Wednesday evening, the Georgia RIA has a Southside subgroup meeting in College Park. Once again, that's the Georgia Real Estate Investors Association. So it's a great organization if you're looking for education and meeting investors, and I will be out there next week. So I'd love to meet you in person. Once again, my name is Matt Martin with PMI Georgia. We offer investors simple, straightforward property management with Southern hospitality. So we manage over 450 doors throughout Metro Atlanta, ranging from single-family homes all the way through small multifamily properties. So we cover a wide area, as far north as Cumming and Gainesville, as far south as Macon and Warner Robins, because we know that deals don't always pop up in the same places. But we would love to talk with you about your investment properties and how we can help you maximize the returns on those. Two of the things that I think we do really well is we protect you from non-paying tenants with really effective tenant screening. Another thing we do is we protect you from tenant damages. We document the property really well. We do annual inspections of the property because we want to make sure that you're not going to get hit with a hefty rehab at the expense of somebody else not taking care of your property. So those are just a couple of things. We'd love to share more with you about how we can help you with that. So you're welcome to go to our website at pmigeorgia.com. You can request a free rental analysis. There's a number of calculators we have on there, whether you're thinking about whether to rent or sell. But if you fill out one of those forms, you'll get a call directly from me. So I would love to speak with you. I'm also sitting here with Chris Littleton, one of the owners of our company. Chris, you want to introduce yourself?
Hi, I'm Chris Littleton. I'm the president of PMI Georgia. We've been serving real estate investors and homeowners for well over 2 decades now. We can help you structure deals, find deals. You know, we're really a turnkey service here for real estate investors. We rehabbed hundreds of properties, help investors bring on properties, rehab them, fund them, and manage those things over the years. And even when you're ready for that exit strategy, we've got a great team to help you with that as well. So we're pretty much full service. And tell you what, real estate's been a blessing for me and my family. And coming through Father's Day this weekend, I got to talk to my girls. And you know what? I remember those days when we started out. And, you know, I always say this, real estate's a marathon, not a sprint. So the longer you're in it, the better it gets. So.
Right. Absolutely.
So we'd love to hear from you. Have any questions? I've just about structured about every kind of deal out there over the years that I've been in business as well. So if you have any questions on how you should set up or structure your deals, we'd love to hear from you as well.
All right. And for those of you who are just joining us online, we do have an in-person event simultaneously. And Chip Cagle is at, with Longhorn Investments, is at Hobnob Tavern in Dunwoody. So Chip, why don't you introduce yourself?
Hey, how's it going, Matt? So Longhorn Investments is a direct hard money lender, and we do loans for fix and flips and also for new construction. Now, of course, the fix and flip could be used for you to buy one and keep it as a rental property. We just don't have the rental loan that you would need. Maybe Sean can help you there. Anyway, so Longhorn on the fix and flip side offers 100% financing. That's 100% of your purchase and rehab, as long as that's less than 70% of the appraised ARV. We can even go up to 75% if you're planning to keep the property as a rental property and get that pre-approval for a rental loan. We've got some summer specials going on right now. The most important one is that normally you have to have completed 3 loans with us to get into our customer loyalty program. But right now, we're letting people fast track into our customer loyalty program if they've completed 3 renovations, even if it was with another lender or they used their own cash. So if you've completed 3, come to us, get in our customer loyalty program, where it'll be 1 point less, and and 2% less interest. All right, and then as far as somebody who's not in the customer loyalty program, isn't able to qualify for that, during the summer, we're going to be offering 1% less interest, or you can choose to have a half a point less on the origination fee, one or the other, not both. So, but if your project's going to take less than 6 months, you'd be better off getting the lower point. And if your project's going to take more than 6 months, you'd be better off with the interest rate, lower interest rate. So I'd love to talk to you about that. Give me a call at 404-216-5599, or you can email me at ckagel@longhorninvestments.com. Thanks a lot. Enjoy the meeting.
All right. Thank you so much, Chip. Now I'm going to introduce our speaker for today. So we have Sean Trombetti, who's a mortgage broker with Reliant Mortgage, joining us today. So Sean's been a Georgia resident since 1972, and he pairs deep local knowledge with a strong commitment to client service. After earning his BBA in marketing from the University of Georgia, he spent 12 years as a quality analyst in the software industry, sharpening his eye for detail. But since 2003, Sean has guided his clients through all types of markets in the mortgage finance industry. So as a broker owner, he's known for being accessible, responsive, and relationship-driven, supporting clients from the first call to closing day. So Sean's going to be sharing with us some exciting new products that are available for investors. We know that this is a difficult environment, especially for investors who are looking just to refinance at a cheap rate or things like that. So Sean has some really exciting opportunities available for us to share. So Sean, welcome to the Atlanta Landlord Luncheon. We're excited to have you speak with us today. Oops, I got to unmute you there. Hold on 1 second.
Sean, give us 1 second.
Oops.
We're still having some audio difficulties.
Yeah, it looks like your mic is muted on the computer.
Nope. He has to unmute, doesn't he?
Yeah, I think he'll have to unmute.
You'll have to unmute on your side on your computer. Or is it his phone?
I think it's on the computer.
We've lost your audio.
Okay, 1 second. He's bringing it back on.
Can we get it?
All right, while he is doing that. So, Chris, why don't you give us a little update? So, in the last few years, we've seen interest rates on mortgages go from historic lows to, I won't say historic highs, but fastest increase, right?
I would say they're more along the normal range. We've gotten spoiled over the last, over the last 5 or 6 years before the more recent uptick in mortgage prices. But I would say it's more like now in the normal range than we had the exceptional values when it came to the low interest rates. So it has been more challenging, for people to cash flow with properties. So you really kind of have to line up your exceptional value properties with the higher interest rates to even get cash flow. But sometimes cash flow is just one of the factors. If you're buying in a good market, you also have to look at your appreciation that you're going to be getting, and and the income that you're going to be getting. But it definitely can cash flow, and I used to say cash flow is king. But there's a lot of properties that are doing well now as far as appreciation. So you're building more. You normally in a good healthy market, you're building as much or more value in a property with appreciation and equity than just as much as you are with cash flow.
Right. But I know there's certainly a number of people who were banking on being able to refinance, and
Yes.
maybe that doesn't quite work right now. And so you have some investors maybe who are real estate rich and cash poor at the moment.
That is true.
That's one of the reasons why I was excited to have Sean share with us, because there's a number of new products that are available. So he's going to be talking with us about DSCR loans, which have been around for a while. But there's also some bank statement loans that they can do, portfolio loans they can do. So there's definitely some good opportunities out there for investors that are on the non-conventional side of things for
It's
financing.
easy to become real estate rich and cash poor when all your money's tied up in equity. You have no platform to capture that equity to reuse it, because a lot of times our clients will take that equity that they have in one property and they want to purchase another property.
Right.
So and if not having cash on hand, because we're in a market where generally you're having to put 20% down
Right.
to acquire an investment property.
Yeah.
So, all right, did we work out some bugs here, or we seem to have everything working and now we've lost it?
Yeah, we still can't hear you on your phone, Sean, but we could hear you when you logged in from the computer.
I don't. There we go.
And let's see here. Oh, we lost him. Maybe he's gonna. Oh, here we go. Sean, can we hear you now? Oh. All right. Well, let's talk about something different while he's trying to get logged in. Technology is an amazing thing until it's not working
Something goes
for it.
wrong.
Yeah. So,
did we get him? There we go.
it looks like his mic is not connected.
I hear somebody chiming in.
So another thing to talk about is the market. So some people think we're headed towards buyer's market. What do you think, Chris?
I think we're kind of in a buyer's market right now. It's an interesting thing, because the buyer's market really depends a lot right now on financing. So there's properties that are selling really quick if they're priced right, but there's other market houses that are staying on the market for a long time. And I think a lot of times we see houses that are coming up that may be on the top end of the market, and that's because the person selling is trying to sell that house without having to come out of pocket, because because it's an unusual market. There may not be any equity in the home.
Mm-hmm.
And so to move the home in this market, they may have to make repairs or put it. I would say some houses are overpriced, and you've seen that as well.
Right.
And so to move those properties, they may need to make adjustments. So there's houses that we're selling for some of our clients. When we put them up, if we don't get the traffic that we want, we make adjustments based on the feedback that we're getting. So,
Sean, are you talking?
Can you hear me?
Yes, we got you. We got you. Yes. Welcome.
Not the picture, but at least you can hear me, correct?
Yes. Yep.
okay.
All right. Well, let me go ahead and bring up the slides for you.
Okay, great.
Love for you to, do a brief introduction of yourself, and we can jump right into it.
And I totally apologize for the technical difficulties. That's on my end, I take it. But I do want to thank both of you guys the opportunity here, because this is an exciting time. I've been doing this, and I think Matt introduced me early on. in 2003. And in fact, I was with First Mortgage Solutions, and probably 90% of our properties and everything we financed were investor properties. At the time, we had a great relationship with John Adams in the Georgia Real Estate Investors Association.
Okay,
So
great.
personally, I have grown up. I've owned 8 to 10 rental properties in that time frame. And I think, Matt, when I met with you, I said I was not a good landlord, so I got out of the business. However, with that being said,
John, you're the best kind of landlord. We'd love to
What's
work
that?
with. You're the best kind of landlord for us. We'd love to manage for you.
And by the way, I'm a big fan of John Adams and Marge, his wife. Known him for years, and you know he's a staple of the Georgia real estate investing market. It's like he's got an opinion on everything, and I think the world of him.
Well, I can tell you, I worked with Peter Burke and Sherry Burke at the time, and they were real. We were endorsed by John Adams, so we used to speak up at the universities. But anyway, so I've been through the investor, the 2008 until today, and the reason I'm so excited to talk, and I wish I could have my pretty face on the camera, is what is happening in front of us to expand not only investor portfolio, but a lot of your investors, I assume, and correct me if I'm not, are self-employed. So about 5 years ago, and the investor community changed, and I mean investor meaning companies that buy loans from lenders, changed and wanted better returns and more aggressive approach than your normal Fannie Mae, Freddie Mac, FHA loans, which, by the way, we're a full service broker and we do. But the non-agency stuff started coming to the forefront. And when I saw that, I teamed up with a couple of our lenders who started beginning stages of this, what they call DSCR loans. And I want to make sure everybody's heard of that. It's a debt service ratio loan. And bottom line, that is a loan that's outside Fannie Mae, Freddie Mac, that allows you to buy the property or refinance via rate and term or cash out, just by making sure the payment can cover, the rental payment can cover the mortgage. And even if it doesn't, in some cases, that can still come into play and we can still close that loan. So I think today we've seen the biggest influx of products for investors and self-employed since 2003, since I've been here. Even in 2003, we didn't have this. So I'd like to go ahead and start the slides, Matt, if you want to go to the first slide. I just feel this is a great segment into the loans we're talking about. Again, we're a full service mortgage broker. I'm with Reliant Mortgage Solutions. I'm the owner. We've been open since 2019. I've been originating since 2003. We fill a lot of niche with non-conventional lending. We sign up lenders who specifically look for that and have investors who buy those loans, such as DSCR loan, bank statement loans, 1099 loans, that allow investors to really expand their portfolio and not have to worry about the day-to-day grind of tax returns, pay stubs. What's this deposit in here? A lot less questions, a lot less hassle, and a lot more flexibility I'll get into. You can go to the next one, Matt.
All right.
Non-qualified loans are just that. The CFPB came out, and I think we all know in 2008, as a result of what happened, a lot of loans were designated QM loans at this time, where the taxpayers, Fannie, Freddie Mae, FHA, were only going to back what we call TRID loans today. Non-TRID loans were not even a thought. And that's what I was talking about 5 years ago. Those type of loans have entered the market. These non-conventional loans are really designed for borrowers with more unique income, credit, or employment profiles that require more flexible underwriting. You can go to the next one, Matt. A debt service ratio loan is a specific loan to real estate. And again, rather than looking at your personal income, tax returns, W-2s. They're going to look at the property. The property is everything. So I'll give you a couple examples later on, but as long as the rental payment can pay for the new mortgage you're going to take on, and that's principal, interest, taxes, and insurance, that DSCR loan is designated what we call 1.0 and is qualified to be funded. Now, what does this mean? This means if your payment's going to be $900 a month with everything, you make $1,000 rental, you have hit the DSCR factor of 1.0 and you have been approved. There is, they do look at credit, but credit's a little bit more flexible. They go down to 680. And they're just looking at the income. Can the property generate the income? That's the key here. It's, like I said, it's common sense. And so that's how they look at these loans and actually fund them. You can go to the next one, Matt. Again, here's an example for everybody out there. Example is $1,800. You got a $2,000 rent roll coming in per month. That means you have a 1.11. You are good to go. You're over that 1.0 factor. And again, there are exceptions in these DSCR loans that you wouldn't believe. They do go down to 0.75. Even if the rent's not carrying the mortgage, there are exceptions, and I've done many of them, and we'll get to that. And again, here we go. To reiterate, I'm kind of skipping ahead of myself, but 1.0 is the factor, and it can go down low as 0.75. And let me tell you, this is on a cash out refinance and purchase as well. You can use these factors in all those scenarios. So the key here is a lot of times investors want to expand. This allows you to expand faster than your normal Fannie Freddie conventional lending, where there are a lot of eyes looking in that world about how fast you're acquiring properties, the leases, what you're writing off. I think if anybody has been through those loans, you have been asked time and time again to document everything. What kind of deposit was this? What kind of what did you pay out? Why was it a $10,000 payout of your account? These loans don't do that. They look specifically at the property and generating rent. There's no cap on properties either. That's a big one. Fannie and Freddie Mac typically cap at 10 finance properties. DSCR has no limit or cap. It opens it up to many, many loans. Now, with a caveat, there's some lenders that will only do 5 or 6 for one borrower. But right now, I think we have 5 or 6 different DSCR lenders signed up. So I would just go to another one. And it's very, very flexible. The DTI limits, DTI, for those of you know, is debt to income. Of course, they're going to look at that in the Fannie Freddie world of qualifying you for a rental property. They just look again at the property, whether it carries a rent. They don't care how much debt you're carrying other than the property, that subject they're looking at, which is incredible. You do have to have the credit score, but again, all the debt that we're going to see on a credit report, it's not analyzed versus your entire income package to see if you qualify. It is specific to that property. Again, advantages: no tax returns, no personal income, thresholds for the DSC, the debt service ratio factors. Like I said, I'm going to reiterate a couple times. To be honest, I've even been down lower than a 0.75. I've gotten a 0.70 exception on these. So this is to say that DSCR loans and other loans of non-conventional nature get a lot of exceptions, because what's really nice is the lender is talking to the investor who's buying it. So they can reach out straight to the investor and say, hey, here's some compensating factors. I know you've had this guideline of 0.75 or whatever. They've got a little bit more assets here. We can show, liquid assets. How do you feel about this? We get an exception. Whereas in the agency world, FHA, conventional, it's black and white. Either you fit here or you don't. Here's some criteria. You got a flexible 680 score. Keep in mind, these qualifications change every month. So what could be 680 today could be 660, or it could go up to 700. No prior landlord experience necessary. You first-time investors who think that they're tapped out, or income maybe not qualify you for the second investment property or first, this is a great tool. You don't need a landlord experience. Cash outs. I do a lot of cash outs. For example, I get a lot of short-term people who use private money, who go ahead and get a loan from a private individual, fix up the property, then come to me, and they can cash out, depending on the DSCR factor, up to 75%. We pay off the personal lender and then get the cash over that back to the borrower. Gift funds accepted. This is a big one. In the world of conventional lending, you cannot get a gift on an investment property. Here, lenders will allow gifts. I think you have to put a little bit in yourself, but you can get a gift for that. They allow up to a 1-day mortgage late on in the last 12 months if they look at your credit report. And here's my favorite, where sometimes reserves come in play. Conventional, it does sometimes on only the subject property and DSCR lending. But if you take cash out, that can count as your reserves. You don't have to have, a stock portfolio worth of $100,000. Your cash out can be your reserves and satisfy the requirement for that loan.
Awesome.
Go to the next one. Yeah. My favorite here is, and I saw this. This was funny. Back in the 2005, when I was doing investment properties, there was a little bit like this. It was non-agency, but of course it would be sold as agency. So that's what caused a lot of the problems. But investors with their cash flow can use the interest-only product with these long-term loans. And if we have a DSCR problem on the amortization, meaning you can't fit into the number, a lot of times I get them approved because they'll use the interest-only option to qualify you on the mortgage payment. Prepayment penalties are on there as well. You can take 0 to 5 years, and there is a significant improvement of the rate if you take a prepay. You don't have to, but it could be up to a half a point to a point, depending how long you take that prepayment penalty. And that prepayment is both on whether you refinance it or sell the property. Go ahead, Matt. The investor doesn't even have to have the property rented in some cases to refinance it. I would suggest you talk to me about that, because or any broker, usually it'll be me, but any broker about that. Cash outs are a little bit more pickier, but rate and term, all they would use, because one of the things they do use in these determining factors of rent is the lesser of your current rent or what the appraiser says the rent comp is. And with investors who've had these, sweetheart tenants for 5 years and may not be charging market rent, they're going to lose in that scenario because they got to take the lesser. But anyway, with that being said, the property does not need to be occupied in order to refinance it. These loans can close, unlike conventional loans, in an LLC, trust, etc. You're still going to personally guarantee these long-term loans, these 30-year fixed mortgages, but you can close in your LLC, your trust. S-Corp's a little tricky. I've seen a couple of people ask about that, but just know that's a nice feature. And then DSCR, with the increase in popularity with the Airbnb, that was never allowed. You kind of had to have a 12-month lease, or there needed to be some data to support what this could be rented for on a 12-year renewable lease. Well, that has changed. So Airbnb comes into play now. A little trickier, but you can actually refinance your property using a DSCR or using Airbnb rental. Who should use DSCR? Here's it's pretty obvious. Seasoned investors, emerging investors, people who purchase refinance property, self-employment individuals seeking investment opportunity, i.e. maybe they don't show enough on tax returns, and then investors for refinance regardless of tenant occupancy. Whether it's occupied or not, you can refinance. Other non-QM loans, this is interesting. Bank statement loans, a big one now. I've got a couple, 2 or 3 $2 million bank statement loans going to closing this week. And basically, for people who are self-employed, they look at only deposits for either 12 or 24-month period going into either the business or personal account, your checking or savings account. So a lot of people who are self-employed may know this. I mean, obviously, when it comes to tax time, they have a hard time qualifying. But in this world of non-conventional loans, bank statement loans will just look at deposits and then apply an expense factor based on that particular business potentially. It could be up to 50%, but I've seen some businesses only like 20% because, again, they're not looking at tax returns and expenses. Give them a 20% factor based on no employees, single employee, not holding much inventory, etc. And they're for self-employed, and these incomes truly show it satisfies the 2010 big scenario with the Dodd-Frank Act about ability to repay. Remember, even though these are non-conventional loans, they have to follow the Ability to Repay Act. This was put in place in 2000. Guess what? Bank statements do. The ability to repay is through deposits in your bank statement. You can go to the next slide. Bank statement loans, flexible documentation based on a 12-month or personal or business. You can go up to 80% loan to value. I have on purchases gotten through at 10% down. If it's primary, if you want to buy using a primary residence, you can use it and do 10% down. But on investments, it's 80% max. And the financing available options are for 2 to 4 unit residential. So you can use bank statement loans on that as well as DSCR. First-time home buyer, no home ownership required in this bank statement if you're buying a rental property. Go ahead, Matt. And you could choose 30-year interest only. Again, the interest only seems to be popular out there. It allows the investors to hold back some cash and gain some traction on a month-to-month cash flow basis. Cash out proceeds can be it. We talked about the reserves. If they need reserves, and they typically ask, they want 6 months on the subject, the cash out is your reserves. You don't have to use it. You just have to show you have. If you get in trouble and you make 6 months payments, can you get it from somewhere? And then again, a 30-day late payment on the allowed mortgage late, which is really tough with conventional lending. 1099 loans, for those of you who are self-employed in 1099, a contractor, a lot of real estate agents are 1099. They are basically self-employed. They'll use these 1099s, not tax returns, to qualify somebody. There's some restrictions here, but you can qualify for 1 or 2 years 1099 documentation. Goes up to 85% in some cases. Loan to value, you have to have 15% of the property. And this is a big one. You can blend a lot of these, not only with 1099, but you can blend. If you're making some W-2 income, you can use that income as well to qualify. And again, interest only is available. You can go ahead, Matt. Profit and loss, get your CPA to do a profit and loss, and they will take that. It has to be signed by the CPA. There are some strict guidelines, but this is a profit and loss only. We're not even looking at bank statements anymore. We're looking at a P&L put together by your accountant. And again, this can be used on rental properties. If you're self-employed in 1099, a great tool. I've done one or two of these. Go ahead. Asset deletion. This is a big one for my retired people buying investment properties. Typically, you would use a DSCR loan, but if you can use assets to acquire rental, meaning I'm retired, I can't qualify with traditional income. If you have a pretty sizable 401, checking, savings, bond market account, they will take that income or they will take that balance and deplete it and give you available income depending on a formula. And I have done several of these lately. Now they've been owner occ, but they've just now expanded those to rental property. So you would just show, for a lot of retired people want to buy rentals too, this is a great way. You show a 401k and you got $1 million. You don't even have to be of age, the 59 and a half. You could be less than retirement age and use assets as income. All they do is deplete it with a formula and say, here's what we're giving you income for based on your portfolio account. And so there's a debt to income there, but just know that exists, and I've done several of those. So anyway, if anybody had any, I don't know, do you take questions, Matt, or anything like that?
Yeah, Sean. I'm not seeing any questions online, but I do have some questions for you. So,
okay.
What are you seeing in the difference between interest rates on conventional loans versus some of these non-conforming loans?
Right, and that's the first question. Well, it's a tricky question. For instance, we may be at 7.5 today, and don't quote me. We would probably be at 7.75 or 7.875 with a debt service ratio loan, maybe with a 2-year prepayment penalty in it. So we're about a quarter difference. Yes, the risk is more for the lender because they're not looking at income, only the rental piece of this. But it's not like a point higher, which everybody thinks when they call me. And the investors love it because I'm not asking them to, go to the blood bank and give me your lab test with all the documentation.
Right. Yeah, it definitely seems like there's a lot less friction for qualifying for these loans.
Yep.
Awesome. Chris, you got questions?
I love the part that, a lot of the clients that we deal with, they're business owners. So I like the fact that the 1099 loans work well for those who are, in the business for themselves. I'm glad to see that because that's always a major qualification hurdle, proving income and your business over, over the last couple of years. I mean, they dig deep and it seems like they're always trying to find something to make you, you get down to the last hurdle and you just don't make it. So I like the outlook of this. I'm sure we have a few clients who would be interested in this. So I'm like, yes, I like the 1099 loan aspect of it.
Right.
Yeah.
Yeah.
And
Sean,
I will say,
go ahead.
It's interesting. If you look at the Democrat, I read a lot about the bond market numbers, job market. With the millennials, it started with the millennials. We are seeing a lot more self-employed individuals coming into the market and companies paying 1099 individuals instead of bringing them on board W-2. So somebody always thought they could never think of a loan, or they're self-employed and maybe their taxable income was a little lower. Have them reach out to a broker like myself or somebody. There is some interesting stuff, a lot of interesting stuff for self-employed individuals.
Right.
They're good loans.
Yeah.
I mean, the theory is they can generate more income if they need to because they're self-employed rather than W-2 employees in some cases.
Yeah, I mean, when you're a 1099 person, I have friends that when they're in business, they expense a lot more items because they're in business. And so
Yes.
It's really, sometimes when they're expensing those items, it's driving down their income. So it does. And this is, it's hard to justify their income with all the expenses they're offsetting, but they're growing, they're growing their asset base too as well. So, I mean, I agree with that. I mean, it's like, I'm glad to see that, because that factor does enter into a lot of our clients that I've seen people just getting turned down. And I'm like, they should be able, with this loan product, they should be able to move forward with as a 1099 employee, as a 1099 earner running
Yes.
their own businesses.
Right.
So,
Oh yeah.
Yeah,
I'm It was
certainly.
typically probably 5 years ago, maybe 3% of the market, what we consider what I talked about today, the non-conventional stuff. It has gone up to, I want to say 20%. So the investors, and really it's DSCR, they can't get enough of these loans. The investors want more of these loans. So the lenders are giving more exceptions out in turn. So it's an interesting concept, because we all know they look at performance loans, and some of the FHA recently it's really coming to a head with we're starting to see some defaults, whereas it's amazing. The non-conventional stuff it's solid. They have equity in it, and the fact is they generate revenue, maybe not taxable, but it's there, and it's a very solid source of income.
Mm-hmm. Yeah. So, Sean, what should an investor do prior to coming to you? What are you going to want to see or find out from them? How can they be prepared?
Sure. And thank you for asking that, Matt. One of the things that I know is come prepared. Really, I love to have a conversation, maybe 30 minutes with somebody on the goals and all that. But if you're going to come prepared, kind of know what your credit score is. That still comes into play. And then know what you're renting the property that you're talking to me about. Or if you're buying one, kind of get a gauge of what it's going to rent for. And then, we can access, okay, here's what your payment's going to be. That's it. I mean, the debt service ratio loans, it's amazing. It's let's talk about the property more than anything. I think in years past, since 2003, it's amazing how much we have to focus on the individual and what's going on in their world. It could be a divorce, anything like that, decrees. This is just focused on the property and, again, the credit report. So I just say call me and we can start. But the key thing is to know the rent flow of the property you're looking at, whether you're refinance or purchasing. That's going to drive everything, Matt.
Right. And we can definitely help clients understand the rental value of the property. It's really tricky. A lot of times people come to us last after they've already been talked into a deal and, put down money on it. They come to us to find out maybe the rent wasn't as exciting as that realtor sold them on. So anytime somebody's thinking about a particular market, has a deal coming up, we'd love to help you out with a free rental analysis for the property. And then we also have a great hard money lender with Chip Cagle. So, Chip, I know you just stepped away for a second. I'm going to start bringing you back in. But yeah, it seems like this would be a great opportunity for investors to get into. They can find a deal that needs a little bit of work. They can do a short-term hard money loan with Chip. And then as they get towards renting this property out, they could refinance out with a DSCR or a similar loan from Sean.
Yeah, absolutely. And I try to make sure, when somebody calls me, it's really good to call me early on. And Chip, I know you're a hard money lender. I've worked with several of them to make sure the lien's recorded, make sure we do it as a rate and term if they want to do it fairly quick, because I want to add, there is a 6-month wait for cash out, but for rate and term, you can refinance a hard money lender out immediately. Of course, it needs to be on title what you're doing. So, and usually all the hard money lenders, they're going to put a lien on the property.
I don't know if you heard me saying earlier that we can go up to 75% loan to value when when somebody gets pre-approved for a rental refinance. So that's where you would come in handy for one of our borrowers. Also, on the front side, when we're getting them into our hard money loan.
Absolutely. I've got a couple who call me and say, okay, what's, in this market, like where the hard money kind of sets the guidelines. Ours does have some guidelines, but what could be true today is not true next week. So it's always good to call me just to make sure everything's in place, and there's some timelines that are still there that we can still meet. But I actually see it getting better because of Wall Street and the type of companies buying these loans. It's not Fannie and Freddie. We're the investor market is the insurance companies, all kinds of stuff with the little bit higher return and the quality of the loan. They're really buying a lot of this stuff. So again, they can't get enough, and it's long term. So I think I help many these lenders, these short-term lenders. They want their cash back, so that's the plan up front. I try to get everybody up front to make sure there's going to be no hiccups when we go to do this.
Yeah, absolutely. And that's probably the best advice, is to know your exit strategy prior to going into a deal, right? My dad's a long-term banker, and he said the worst person to loan money to is the person that needs money. I highly encourage any new investors, emerging investors out there, talk to Chip, talk to Sean beforehand as you're scouting out deals, and they can also help you understand some of the metrics of what looks like a good deal in cash flowing to property. And we can certainly help you with everything in between there as well.
Sounds good.
All right. Well, Sean, thank you so much for joining us today. It was really a pleasure having you on. Guys,
this is great.
Just
everybody didn't get a chance to see my face except on that little slide there. Right?
Yeah, absolutely.
I've got more hair, I promise you.
That's right. Well, good. Well, right. Sean, what's the best way to reach out to you if they have questions?
Just my cell phone, 404-641-1486. You see it up there, and I appreciate that. And there's my email address. And I love investors. I grew up, so I'd love to talk to you. So whenever and you can look up my company. I'm the owner, so you'll find me.
All right. Absolutely. Well, thank you so much, Sean, for joining us today. Chip, any final words before we part?
It looks like our next meeting will be in July on the 21st.
Okay.
July 21st. Do you have a topic for us yet, Matt?
Not yet. We'll get something scheduled on the books soon.
To be determined.
Yeah.
That's right.
All right.
Well, cool. Good. Well, I know Chip goes to the Atlanta RIA events as well. So if you're looking for more networking events to get out and meet some people, Chip and I both are at that meeting, which meets monthly. So we'd love to get to meet you guys in person, and we'll see you there. Chris, any final parting?
Thanks for joining us, and I tell you, I think this is a great opportunity. I mean, I've been looking for some opportunities to qualify properties instead of me.
Yeah, absolutely. So, yeah, and I think especially as we're entering what looks like will be kind of a buyer's market in Metro Atlanta, there's going to be some opportunities out there. So it helps to make sure you have some cash available at your fingertips, so that when that deal comes across your lap, you can jump on it.
Yeah, I think we're going to see some opportunities for this kind of financing, and maybe even some opportunities for some subject twos as the market, the economy's stable, but there seems to be some opportunities possibly coming up for some foreclosures and short sales.
Right. Absolutely.
Which has been slim pickings for quite a while now.
Right.
So, all right, everybody. I appreciate it. We'll see you in July.
All right.
Thank you.